Hi. So what we'll do today is we'll understand the difference between a normal return and a log return. Most of you are already aware of the normal return. Let's look at how the log return or the natural log return or the ln return works. So first thing we need is we need to find a database for which we need to have a return. Nifty is always good. So let's take a chart of Nifty historical prices. Uh, Nifty historical Yahoo Finance. Yes. So I'll take a monthly frequency for the last 10 years. So today is the 1st of December. Nifty hasn't closed yet, so I'll take it till the 30th of November, starting from, let's say, 1st of January in 2010. That's it. And I can apply this first. This gives me a historical return. It's actually a little less than 11 years. 1st January 2010 to 30th November or 1st November 2020. So that's okay. And I'll download this database. So this is actually monthly highs and lows and closings. And we download it. I am not interested in the open high and low. I'm only interested in the monthly closings. Let's decorate this a bit. Freeze panes, date. Okay, so this looks pretty decent now. Now we're already aware of normal returns. Like you can't really do it for the first period, but in the second period, what you do is you take your ending investment, you calculate your profit or loss, and you divide it by the base percentage terms. So this is your normal return. A log return works a little differently. Log return uses the ln formula or the natural log formula, and it takes the ending investment divided by the beginning investment, percentage terms, two decimals, and you see it's approximately the same. Like in some areas where the actual in return is high, you see the difference. Like here, minus 3.63% to minus 3.7%, or here minus 1.15% to minus 1.16%. But for a smaller value like 0.94%, and the difference actually increases when you have a larger number. Like even here, the difference is not much, but if you have a larger number here, the difference is about 0.6%. So as the number grows higher, the difference between the normal return and the log return grows higher. Now, what are the advantages and disadvantages of both? So let me take a 1 year period. Let me take a 12-month period. So this is 12 months. Although the returns are for 12 months, so I'll actually have to take data points for 13 months. So this is my 12-month period, right? So here, if I have to calculate the total return, and I'll be tempted to do a sum of my return for the last 12 months, and this will be wrong because you cannot calculate returns, because this 6.64% is not on my original base. This 6.64 is on 4922, which has already been adjusted by this 0.82%. The way to do this is to actually shift your base. Once you shift the base, you find your actual 12-month return, which is your ending period investment minus the beginning period investment divided by the beginning period investment or the base. For a log return, you can actually take the sum. And this will be exactly equal to the ending period investment divided by the beginning period investment, which will be exactly same. How exact? This exact. You want more exact? This exact. There is a difference in the 16th decimal place, which is an Excel error. If I am to use the comma, it's all, you can see the differences here. Whereas in this case, the difference is this much. So that's one of the advantages of the log function. The second advantage is the calculation of CAGR. Since the log function returns are additive in nature, my CAGR is simply this divided by 12. Nothing doing. This divided by 12, which means if I am to calculate the returns on 4882 for 12 periods using this number, I will get exactly 5506 in a log return sequence. However, in a normal return, the CAGR formula is a little more tricky. So this was my return. How do we calculate CAGR? Most people do not get the concept of CAGR. CAGR is equal to my final. CAGR is calculated by an equation which says my final investment is equal to my initial investment multiplied by 1 plus CAGR raised to the power 12. So this 1 CAGR will have to be constant for these 12 periods. Now, if I want the CAGR, I will have to do some backtracking. So the A goes here. The raised to the power 12 will go here in an inverted manner. So that becomes 1 by 12. Can remove this bracket now. Take this one away. And this is my CAGR. Add another bracket for clarity. And this is CAGR. So let's put in the values. B is the final investment, that is 5506. A is the initial investment, that is 4882. And we have our CAGR of 1.01%, which is almost the same of the CAGR calculated by the log return because it's a very small value. However, now let's see if our CAGR calculation in both cases has been right or not. So we use this formula for the 12 periods, that is 488. That is 4882 multiplied by 1 plus CAGR raised to the power 12 should give me 5506. Perfect. Whereas in this case, I can simply use 4882 multiplied by returns in the log equation are calculated a little differently. So here I calculated return being my initial investment multiplied by 1 plus rate of return raised to the power time period. Here it will be a little different. Here it will be my initial investment. So I'll take the same formula. My initial investment remains the same. However, this whole thing changes. This whole thing becomes exponential of this thing. Now, since there are 12 periods, I will directly multiply 12 here and I'll get my final value as 5506. So this thing is a little less intuitive because every time I want to calculate my return, I have to use the exponential formula. So to get from 4882 to 4922 using a log return, I'll always have to use the exponential formula. This is something we'll need to remember. Multiplied by the exponential of this return. And you'll get a final value, which is exactly the same here, 5506, 5506. But this is a little less intuitive. So what are the advantages of the log function? The log function is additive in nature. The log function gives you CAGR in a much less complicated way. And but on the flip side, the return calculation, the inverse calculation is a little less intuitive. But once you get the hang of it, it becomes second nature. Now, why do I recommend the log return? Let's say you have an investment of 100 rupees, and let's say you're either making a profit of 15 rupees or a loss of 15 rupees. And somewhere in the range of 15, not exactly 15, let's say you won't go more or higher or lower than 15, which is what typical investments also give you. I think it's really rare to see any investment going above or below 15% profit or loss. That does happen in the market though. So my closing price is this. So on a normal return, I would get my final investment minus my initial investment. I'll log this divided by my base. Log this again. And minus 15% we have for a normal return. In case of a log return, I'll do final return divided by the base. And the difference is a little higher. So the difference is not much when we're close to zero. For small numbers, the difference is very small. The difference becomes much aggravated as we approach higher values. So for a much higher value, let's say somewhere in the range of 70%, you see the difference is massive. That is not acceptable. However, typical investments will not take you above or lower than 20%. CAGR wise talking, the last 10-year Nifty return has been 11%. This I'm talking pre-COVID time. So this is a pretty good way to actually think about your returns and calculate your returns much faster. Obviously, if you prefer, you can use the normal return calculation. But say you're doing it for multiple periods and the periods are uneven. Let's say you're doing it for a month, then a quarter, then a year, then a month again. So log return actually gives you that flexibility to keep it additive. And at least it's good to know that there are more than one ways of calculating your returns. So that's it for now. Thank you.